All information contained in this podcast is general in nature and does not consider your individual circumstances. You should consider the appropriateness of this information with regards to your individual objectives, financial situation, and needs. Welcome to Sharing More Than the Sheets, a podcast to help you and your partner make better financial and lifestyle decisions so that you can both focus on the things that you love. I'm your host, Michael Curry, financial planner, green thumb, husband, and just dad. I wanted to talk about the benefits of investing long-term. Now, every person's situation is completely different and every investment is different in many different ways. So this definitely isn't a blanket rule for all types of investing, but I wanted to highlight the importance of just really understanding that investments usually are more of a long game and a long-term thing instead of a short-term thing. And as an advisor, you can just imagine the conversations I have with my clients, and you can imagine the types of scenarios I've come across and the type of investments I've come across and the type of investing habits that I've come across. And I can confidently say that those, generally speaking, most of the time, not always, but most of the time, those that invested long-term and had long-term goals and long-term strategies that they stuck to usually end up doing a lot better than those that just have short-term goals and strategies and chop and change or have a long-term strategy that they don't really follow. And that's for many different reasons. And the first one is that investing long-term, statistically, you're more likely to get better returns long-term compared to somebody that just invests short-term into the share market or the bond market, for example, or even the property market. If you look at somebody that's bought a house 1 year and sold it 3 years later, unless they bought just before a boom, they most likely haven't made as much money as someone that bought a house 20 years ago and sold it today, for example. The main reason for this is because when you invest long-term, there's a much higher chance of you riding out highs and lows. So you're there for the bad times, but you also end up being there for the good times. Trying to time the market can be very dangerous because you might get it right here and there, but you'll probably get it wrong in the same number of areas, if not more. So riding out the highs and lows can really be beneficial. And if you look at the stock market over the last 20, 30 years, if you look at any 10, 15, 20-year period, or even shorter, you'll find that markets generally have always gone up. And even with the dot drops and, we're talking the GFC and the dot-com crash and COVID and, the GFC seems to be the most popular one that people sort of remember and stick to. But even with all that, if you look at the market, if you look at any chart, pull up the chart of what the ASX 200's done or what the share markets have done, even in the US, the S&P 500, you'll find that markets, yes, there's been ups and downs, but if you look at one period, then look at another 10-year period later or 15-year period, you'll find that it's gone up. Now, obviously, it's important to note that past performance is not an indicator of future performance, and that's something that we need to highlight very importantly, and I always explain this to my clients, and I'm explaining it to you because while I'm telling you this is what markets have done in the last 30 years, it doesn't mean that it's the same thing. That it doesn't mean the next 30 years is going to look the same. It could be completely opposite to that. So that's a very important factor that I need to drop. A disclaimer and a warning that we don't have a crystal ball and that we don't know what the future is going to do. The other thing is when you invest long-term, your investing decisions are more likely to be less emotional. And that's really important to understand because when you're investing short-term, it's very easy to let emotions get to you, to get spooked by the media, to get spooked by market drops, to get spooked by conversations that you have with clients and friends and to be influenced by that. And when you just agree from day one or you have a strategy with your advisor and you just say, you know what, we're going to invest long-term. This is long-term. This is for my retirement. That's in 10 years, 20 years, 30 years. This is our strategy. When you have that in your mind, you're less likely to chop and change every week. As well as that, investing in terms in the long term can potentially be more cost effective because there are less buy and sell costs of buying into different investments and shares. Because essentially you've just bought the investments, whatever it may be, and I'm being very general here, and you hold them instead of just buying and selling regularly, which can also incur costs as well. Also, depending on the type of shares that you buy, you would benefit from the compounding with dividends that you potentially could be receiving from those shares as well when you hold them in the long term. And the other side of it is there could be some tax benefits as well holding shares long term compared to short term as well. All in all, like any financial strategy, thinking long term, you're going to end up being a lot more in a much better position compared to if you just think short term all the time. Keeping that in mind, it's also very important to realize that it's important to review your strategy regularly. So I'm definitely not saying that an investment strategy should be a set and forget strategy, because circumstances change, markets change, so many things change. Your goals will probably change over time as you're investing. But it's really important to understand the importance of thinking long-term instead of short-term. And part of that can be consistently investing money and not just doing it once off or once a year or whenever you get a bit of extra cash, but actually setting up a regular investment plan where you're consistently putting away a certain amount per month or per week. And consistency, again, I've talked about consistency already in the last 3 or 4 weeks, but consistency is important when it comes to so many things in our lives, but especially investing. Consistency is key compared to just literally doing things when you feel like doing it or just for the sake of it. So all in all, thinking long-term instead of short-term has many, many benefits when it comes to investing. Financial, emotional. It's, as an advisor, again, I've seen what people have done well. I've seen what people haven't done well. And all I can say is having a strategy and having a long-term plan and thinking long-term, if that's what your goal is, if it's long-term, like retirement, for example, or something else, having all that in mind, you are more likely to make better decisions for you and your family, better investing decisions, and also you're more likely to enjoy the experience a lot more compared to somebody that's got the finger on the pulse and literally emotionally just stressing out and making changes and chopping this and stopping that and looking back and having regrets and wishing they did this or that. And it's obviously it's horses for courses. There's this for everyone's situation is different, but as you can tell, it really depends on your circumstance, depends on your strategy and what you're trying to achieve. But I think you get the message. So I hope you enjoy your journey of investing. Highly recommend, of course, that you speak to an advisor. And an advisor can sit and talk to you and help you with these things. And reach out. Feel free to send me a message, send me through questions so that you can become a better investor. Thanks for joining us on Sharing More Than the Sheets. Please make sure you subscribe to be updated with future episode releases. And feel free to share this episode with any friends or family that you think it might benefit. Please visit us at sharingmorethanthesheets.com.au to submit questions or requests for future podcast topics. These podcasts have been brought to you by Better Financial Planning Australia. To book a 15-minute phone chat, visit betterfinancialplanning.com.au.